Tax Cuts and Jobs Act that was passed in December, there's a lot to cover, and as Stephanie said, we'll have a separate one on businesses. Today we're going to focus on individuals. So again, thanks for joining, and as she said, if you have a question while we go, just put it in the chat function, we'll try to address those. A lot to cover, so we're going to move at a somewhat rapid pace to cover everything, and we're going to try to keep things simple and not too complex. Just real quick, you can see back in December, you all know that the new law was passed. This was the largest major tax reform in over 30 years. So a lot of provisions, and again, we're going to focus on the individual provisions today. In the news is the big corporate tax cut rate again, but today we're going to focus on the individual provisions. Note that most of these provisions come into law for 2018. So again, what that means is for the tax returns you're filing now, they're for 2017, even though we're in 2018. So sometimes I see comments on, oh, I didn't see anything change. Oh, 2017 is what we're filing now. So you won't really see this on your tax return till next year, but it doesn't mean we can start planning now for the new law for 2018. It's also important to note that most of these provisions expire. They're only temporary, all the way up to 2025. So we have about 8 years. And that doesn't mean that something can't happen in the interim. Congress can always act to change the law in the interim. There's also updated withholding tables, and if you are an employee and you get wages, you may have already seen in your paycheck a little more take-home pay with the new withholding tables. So that's important to note also. So we'll get started with the tax rates and the brackets. So what this is here is taxable income under the prior law, which is the tax year 2017, which really affects your 2017 returns we're filing now, and the new law, which is for 2018 through 2025. If there's no other changes in 2026, we'll go back to the existing law, which is that 2017. So if we look at this, taxable income, just as a reminder, taxable income is your income less your deductions and exemptions. So if you have wages of $100,000 and then you have deductions and exemptions of $20,000, then your taxable income is $80,000. So that's what taxable income is. So here you can see the lowest rate stays the same. It's 10% up to $19,000, $19,050. So this is a tiered approach. So your first $19,000 is at 10%, and then up to 77. From 19 to 77 is under current law, or we'll go back and forth for current versus prior law, because remember, it's 2017 that we're talking about. You get up to a 15% rate. That's going to drop to 12%. Then you can see the other tiers here, and where depending on where you might fall with taxable income. Not only do the rates go down, the rates will start to go down and be a little bit less, but you'll notice some of the brackets increase where that third bracket used to only be to 156, now it's to 165. That fourth bracket used to only be to about 238, now it's to 315. So you're going to get more room in the lower brackets also. You can see that top rate now is 37 for 2018 instead of 39.6. The single brackets are just about half this, but for when you're reaching the top, it's a small differential. But we just wanted to show this for visual purposes for people in the married filing joint bracket. This is another visual that sort of shows the comparison versus, again, this current law for 2017 versus the new law, the Tax Cuts and Jobs Act, or the TCJA. For 2018, you can see for married filing joint on the top, you can see the current law where it goes 1015 up to 40.8, and then the new law where it goes from 10 up to 37. That green bar in the middle means you're better off in every circumstance from a rate standpoint under the new law. Now, what you may notice is the top rate was 39.6, so why do I see 40.8 there? And the reason for that is factoring in the repeal of the overall itemized deduction. So once you make a certain amount of money, income, this is for higher income, say over $300,000, you start to lose some of your itemized deductions. So this factors that in. Say you were 39.6, you're really paying 40.8 in the top bracket because of that reduction. Go to the bottom and you can see the individual, and you're pretty much always better off. And the only time where you're not better off is right in that sweet spot around that 200 to 400, where you were paying maybe 33 to 34, now you're at 35. So you can see the difference really isn't that significant. You're talking about 1% to 2% more. So for the most part, rates are going down for everybody. So everyone, from a taxable income standpoint, the tax should go down. What we're going to get to, though, on the flip side is some of the deductions and exemptions are going away or being limited. I just wanted to throw in here that the capital gain rates still apply. So just important to note, if you have long-term capital gains, meaning you hold stock for more than a year and you sell it for a gain, or if you have dividends from stocks, those get lower rates. So you can see you get 0% if you're in the 10% or 15% ordinary bracket, and you get 15% or 20% depending on where your income is in the higher brackets. So it's important to note that still applies, and there's also a 3.8% net investment income tax from the Affordable Care Act that still applies. That 3.8 doesn't hit until you're about 250 for married filers. So you can see where people will fall for that. Again, we just included it in there to remind, nothing changed there really. It's just that still applies for people, so we thought we'd throw that in. The AMT, our alternative minimum tax, before we get to the deductions and exemptions, we want to make sure at a high level you might understand what AMT is. We can do a whole hour just on AMT or the alternative minimum tax. In short, it says take your income and your deductions, figure your tax for regular purposes. And then there's AMT, which says you're not going to get certain deductions. We want to make sure everyone's paying a certain amount of tax. So you're not going to get certain deductions like state taxes, you're not going to get miscellaneous deductions, and you're not going to get personal exemptions. And then there's a straight 28% rate, and there's a flat exemption. So basically, at the end of the day, some people in the sweet spot of, say, $200,000 to $500,000 of income will pay this AMT for 2017 because you're not going to get certain deductions. Now, for 2018, a lot of people that paid AMT in 17 will no longer pay. And the reason for that is these deductions that were limited, some of them are going away, and the exemption amount for AMT was raised so high that a lot less people are going to be affected. So bottom line is a lot of people that were in AMT are not going to be in AMT anymore. Okay, so now we get to probably the most important part is the standard deduction versus itemizing deductions and also your personal exemptions. So this affects, today a lot of people for 2017 will itemize their deductions. That's where you write off your itemized deductions like your state taxes, your property taxes if you own a home, your mortgage interest, and your charity. Those are the most popular ones. The standard deduction says, well, for those people that maybe don't have that much in itemized, we're going to give everyone a standard deduction. And for 2017, for married, that was $12,700. If you were single, it was $6,350. Well, the new law nearly doubles those amounts. You can see now we're up to $24,000 for married and $12,000 for single. So essentially what this means is a lot of people that did itemize before, now the standard being so large, you may not itemize your deductions anymore. It's possible that, we'll go from over maybe nearly half of taxpayers itemizing to possibly as low as only 1 in 10 taxpayers itemizing. And it's important to note also, if you're 65 or older, you also get an additional standard deduction. So there's $2,600 extra to throw on top of your $24,000 if both spouses are 65 or older. If you're single and you're 65, you get an extra $1,600, so that 12 becomes $13,600. If you're married and only one is 65, you get $1,300 more, so that 24 becomes $25,300. So that's sort of that amount to beat. So you have your itemized, and if you beat the standard, you take your itemized. So in 2017, a lot of people beat the standard. but in 2018, a lot of people won't beat the standard. We'll get into the deductions a little bit more. First, we'll touch on the exemptions. So personal exemptions means for yourself, for your spouse if you're married, for your dependent kids, or for any other dependents. So if you have dependents, if yourself is and your kids and your spouse, $4,050 a piece that you get as a deduction. So if I'm married and I have 3 kids, that's about $20,000 of exemption or deduction that I'll get to deduct on my tax return. Now it's important to note, if you're in AMT and you're not getting the exemption in 2017, that's one that's not allowed. It's also important to note, if you're higher income and not in AMT, once you're making over around $300,000 or more, you start to lose these exemptions anyways. So where this hits people are the ones that are maybe less than $200,000. They're not going to get those exemptions anymore. But so before we get too angry at that, we'll go to the next slide, which is going to show that we get an increased child tax credit to sort of offset that blow from losing the personal exemptions. Congress has said the goal here was to simplify things, so the simplified standard deduction, losing the exemption, replacing it with an increased child tax credit. So the child tax credit for 2017 is $1,000 per child under 17. For 2018, it'll be $2,000 per child. The refundable piece, the $1,400, is if you don't have any tax, you may still get an extra $1,400 depending on your earned income. The biggest thing here with the child tax credit is a lot of clients say you're making $150,000. You may have made too much money to get the child tax credit because it started to phase out, or you started to not get the credit at $110,000 of income. So Congress said we're gonna increase that to $400,000. So now taxpayers, when you're married, if you're single, it's $200,000, but $400,000 if you're married. So those people making $150,000, $200,000, $300,000, they're going to get the child tax credit now at $2,000 per child. So if you go back to my example, I'm married with 3 kids. I was getting $20,000 of exemption. Say I was paying 25% tax to use that tax bracket. That benefited me about $5,000 of tax, because $20,000 of deduction at a 25% tax rate, that's $5,000 of reduction to my tax. But now I'm going to get $2,000 for each of my kids under 17. So now I'm going to get $6,000 of child tax credit to replace that $5,000. So I actually come out ahead $1,000 in that example, assuming I wasn't getting any child tax credit before. There's also a family tax credit. So if I have kids, or if you have kids in college and you're still claiming them as a dependent, you weren't getting a child tax credit, you were getting an exemption. The exemption's gone, so now you'll get a $500 credit for each of those. So now we're going to get more into the itemized deductions. So with itemized deductions, one of the most popular one is the state and local tax. There was a lot in the news about this, and essentially for your property taxes and your state income taxes that you paid, you were able to deduct all of those in 2017. If you happen to have minimal state income tax, you may have taken the sales tax instead if that was more. So you take the greater of the state income tax or the sales tax. But for many people, it's property taxes and state income taxes. So say here in Illinois, if somebody makes $200,000, for round numbers, say their property taxes are 10 and their state taxes are 10, they have $20,000 of this SALT deduction. Well, for 2017, you can deduct the full $20,000. Now for 2018, under the new law, that's capped at $10,000. So you'll go from deducting 20 to only deducting 10,000. So for the state and local tax, that's important to note. Remember, if you were an AMT, this won't really affect you too much because you weren't getting those deductions anyways, or those were limited for the AMT. The next one that there's some changes to is mortgage interest. So with mortgage interest, for many people, for many taxpayers, it's sort of status quo because this is really for new loans going forward. If you go out and get a new loan now, it's limited to $750,000 of debt, whereas your grandfather, if you had up to $1 million. So for people with larger homes or maybe a second home, this is more of an issue. For those with smaller homes or loans that have been paid off or paid down, this isn't really too much of an issue. So it's just important to note that if you have an existing mortgage with $500,000 and you want to go out and buy a second home with $400,000, that's going to be $900,000, and that's over the $750,000. You'd only get $250,000 on that second home. Interest on home equity. This is in the news too, and you'll see some articles out there that just say you can't deduct home equity interest. So it's important to read the law and not just read articles. The law says that if that home equity loan or home equity line of credit was used to substantially improve your home, so if you took out $100,000 to do your bathroom and your kitchen, you can still deduct that interest. That's not a problem. If, however, you use that money to go buy a car, to pay for your kid's education, that is not deductible. So it's important to distinguish between the two. And it's really, the onus is on you. It's not going to be anything on the tax reporting statement. At least at this time, there hasn't been any talk about that. So it's really when you go to file your return. At the end of the day, this may not even matter because you may not be itemizing anymore. You might be just taking the standard deduction. So again, you'll work with your tax preparer on that to figure out what the right thing to do is going forward. Charity, there really wasn't much that changed with charity, but it's in the news too because people are wondering, are they going to get benefit from their charity? So the overall deduction used to be limited to 50% of your income, and now it's 60%. This is usually not an issue for people, so it's not too much in the news about the limitation because you're pretty much going to deduct your charity. If you happen to give stock to a charity, that's limited to 30% of your income. That didn't change. It's important to note if you happen to be someone that gives to a university for the right to buy season tickets, you used to be able to deduct 80% of that. That is no longer deductible in 2018. A few other itemized deductions. Medical. Medical is 7.5% of your income floor. What does that mean is if you have $100,000 of income, then there's a floor for 7.5% of your income. So for that $100,000, the first $7,500 is not deductible, and anything over that is deductible. After 2018, that floor rises to 10%. So if you have a lot of medical, you may still itemize. If you don't, a lot of working people won't have as much medical as, say, retirees, and retirees may have lower income, which allows them to deduct their medical. So it's really a case-by-case basis. Casualty losses, if you happen to have a tornado, those used to be casualties and deductible certain limitations. Going forward, it's limited to federal disaster relief areas. So if the Fed says they've said it's a disaster relief area, you could still take a casualty loss. If not, there's not a loss to deduct. Miscellaneous deductions, these need to be more than 2% of your income, so a lot of people won't get these because of the 2% floor. And the other thing to note is if you were an AMT, you weren't getting benefits from these. But if you have an investment advisor, you pay investment fees. If you pay tax prep fees, if you have unreimbursed employee expenses. Congress simplified things by saying we're going to give you the bigger standard deduction, and you won't be able to deduct these on your tax return in 2018. Now, if you have tax prep fees related to your business, those are still all deductible. If they're related to your rental property, you'll take those against your rental property. If you're a sole proprietor, you'll take those against your Schedule C. If you're an unreimbursed, if you're an employee and you get an unreimbursed, try to go to your employer and try to get those reimbursed, and then they can work with you on that, and then perhaps get a deduction at their business level. There was a lot of commotion at the end of last year, 2017. Why should we prepay our taxes? I'm hearing that in the news. This is something we did back in December. We just are trying to clarify for people. We still get questions. So why did I do that? Or I heard somebody did this. Why would you want to do that? This is just a simple example showing for the Hills here in 2017, they had state tax of $8,000. They had property tax of $11,000, mortgage interest of $9,000, charity of $3,500. So this gives you an idea how what's called Schedule 8 itemized deductions work. their total itemized for 2017 would have been 31,500. So they take the itemized, right, because that was more than the 12,700. Now, in 2018, without planning, they were limited to $10,000 of a tax deduction. They have the mortgage interest and charity, assuming the same. Now their itemized is 22.5. The standard, though, remember, is going to 24. So the standard's going to be more. So it's like they're not getting benefit in 2018 for their deductions. But Congress is giving them an increased standard deduction. So what we wanted to do was say, okay, how do we get some benefit from taxes? And we also looked at charity too, to say, so prepay taxes and front load some charity. And if you did that under the with planning, that's where you can see they came out ahead, depending on their tax bracket, by as much as $3,800 or $6,000, because their itemized deductions in 2017 increased, and they're still taking the standard in 2018 because they have itemized of $8,300. It doesn't matter if they have $1 of itemized or $22,000 of itemized. They're going to take the standard of 24. So that will help people out there too. I'll talk about the donor advised fund in a minute too with charity. But again, with planning, basically we're looking at, you may want to bunch medical to get above the floor, and also if you want to try to itemize. If you're not going to itemize, you want to pay down your mortgage possibly, or pay down your home equity, especially if that home equity wasn't for improving your home. If you have vacant land perhaps as an investment, you may not get the deduction for the property taxes, so you might want to what's called capitalize those, which is add them to the cost basis, so work with your tax preparer on that. And then charitable giving strategies, we don't want to overwhelm you with these today. We're going to have a separate webinar coming up on charitable giving strategies because we can devote a whole 20 minutes just to that. So we're trying to keep these webinars within a half hour. So we're going to have a separate one just on charitable giving strategies where we're going to go into these in more detail. So watch your email, watch our website, watch our newsletter, and we'll let you know when that is. It's probably going to be in early May, and we'll go over, okay, if you're going to take the standard, well, is there a year where we can bunch? How can we get benefit from our charity? If we're giving $3,000 or $4,000 or $5,000 a year to charity, and we're not getting benefit because we're taking the standard, what can we do to get those benefits? So we'll devote an entire webinar to that so we can make sure we cover that in good detail. If you happen to have an IRA that is managed by an investment advisor, in the past you may have paid that outright from your pocket or from your after-tax account to get the deduction. Now going forward, you probably want to take that from the IRA, so work with your advisor on that. Couple small changes, alimony for divorces that are happening now in 2018. The old rules still apply, meaning pick up alimony as income, deducted, but after 12/31/18 that will change. Roth IRA recharacterization. Basically what this is you take IRA, convert it to a Roth. The Roth is tax-free forever going forward, and you pay the sort of the entry tax to get into the Roth. You used to be able to undo those if say it went down in value, you want to put it back. You used to be able to undo those. They got rid of that. You can still undo a 2017, but if you convert in 2018, that's no longer available for you. 529 plans for college. You can now use those for K through 12, up to $10,000 per year per student. Moving expenses used to be able to deduct, and those are gone. Kiddie tax, if you happen to have kids that are your dependents and they have more than $2,000 of investment income, unearned income, it used to be taxed at the parents' rate, now it gets taxed at the trust tax rate. And finally, the Affordable Care Act, that the health insurance mandate, has been eliminated beginning 2019. So when you file your tax return for 2017 for 2018 and you don't have health insurance, a penalty may apply. For 2019, that goes away. I dropped in the tax brackets for the trust just to see for the kiddie tax here. Estate and gift, real quickly, these exemptions these have been going up every year, and now they've increased them so much that many people, if they pass away, will not have an estate tax. So it's now up to $11 million per person. It used to be as low as $1 million. So it's going up, so a lot of people won't have any estate tax issue anymore. few cases here just to finish up. We have 3 quick cases to go through, and we'll be finished. This is just a couple where a salesperson has a lot of unreimbursed employee expenses. So for 2017, you can see the total income is 164, taxes of 13, that's state taxes and property taxes, mortgage interest of 8,300, charity of 3,300, and then those miscellaneous work-related were as much as 15,000. So total itemized 40,000, clearly more than the standard. So you take the itemized to 40. This is the 5 exemptions that they have. So 20,000 for exemptions. Taxable income is 103. They actually have AMT because of all those miscellaneous deductions, a little bit of AMT that they're paying. So their tax under 2017 is 17,000. They still qualified for a small child tax credit of 250 with the phase out. Now for 2018, their tax deduction is limited to 10, remember, because that's a flat 10. Interest is the same, charity is the same, and they don't get any miscellaneous. So their itemized drops to 21,000. So they're going to take the standard of 24 because that's more. So now their taxable income, then there's no exemptions, remember, so that's 0. So the taxable income actually goes up by 37,000 to 140. So their tax before any credits is 22,007, but they're going to get 3 child tax credits of 2,000 apiece. So take the 6,000 off, and it looks bad on its face. We're going to lose our deductions for miscellaneous. We're going to take the standard instead. We're not going to get exemptions, but the bottom line is their tax goes down by $700. So we tried to pick one where it sounded really bad, but they come out ahead. The next one's retired with investments, and you can see here they paid a lot of state taxes and property taxes, but they're going to be limited to $10,000 in 2018. They paid a lot of investment advisory fees. That's going to be limited 0. So they go from $70,000 of deductions down to 11. So you can see their exemptions. They had 648 because they were being phased out. That goes down to 0. They paid a lot of AMT. That went away. So you can see here the bottom line for them is their tax actually does go down a little bit. Even though their taxable income goes up, the tax rate the lower tax rate that they're paying reduces their tax. Lastly, we have wages with 4 kids, 3 are in college. So essentially what they're looking at here, income of around 220, their taxes get limited to 10. We'll say charity and interest are the same. So their itemized is 22.5, but they take the standard because it's more, it's 24. They lose all the exemptions, but they were subject to AMT, so they really weren't getting benefit anyways. They're going to get a child tax credit, $2,000 for their younger child, and $500 per child that's over 16. So their tax still goes down by about $2,500, even though they lost certain deductions and exemptions. This is one example when we talk about charity in the next charitable seminar, how we can help, because they're not getting benefit from their $10,000 of charity here. They're going to take the standard. So we're going to help them so they can get benefit of their charity each year and have additional tax. So with that, I appreciate, we really thank you for your time today. And we went through a lot. Hopefully it was easy to follow and it makes sense. And if you do have some questions, the chat function's available. You're free to drop off the call anytime. I'll stay on for a few, and as long as there's some questions coming in, I'll address those questions. And if you have any questions, go ahead and use that chat function. Otherwise, thanks everybody, and have a good afternoon. Thanks for joining.